Good morning, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing Podcast. I'm your host, Real Estate Cody, and joining me, as always, is my good old partner in crime, Mr. Brian Alfaro. Brian, great to see you again.
Mr. Real Estate Cody, what's up?
I love the sound of that. It just has a good ring to it. We're
You
going to
gotta
come
get the
up with.
license plate.
Oh no, I don't know if I want to venture down that path, but anyway, hey man, we're really excited about our conversation this morning with a very prestigious guest who I've been looking up to for some time now. So tell us who that is.
Absolutely. Today we have Mr. Brian Briscoe. He spells his first name the right way too, so I like that. Mr. Brian Briscoe is the co-founder of the apartment investing firm Four Oaks Capital and the director of the multifamily educational community, the Tribe of Titans. He's also the host of the Diary of an Apartment Investor podcast, which I've listened to many times. He is an active duty Marine Lieutenant Colonel, retiring very soon after 20 years of service. So, Mr. Brian, first of all, thank you for your service. And secondly, welcome to the show.
Hey, thanks a lot, guys. I appreciate you guys having me on. And incidentally, we'll be recording an episode with Cody on my podcast here in a week or two. I don't remember exactly the day, but I know it's on the calendar.
Awesome.
Yeah, I know it's been a long time coming, Brian. I know we talked about this probably almost a year ago. I'm excited that we finally got to this point, and echo Brian's sentiments as well, man. Thank you so much for your service and all that you've done for our country. And not that you're counting days, but how many more days you have left before retirement?
I actually stopped counting, which is weird. Most people who know me knew that I was counting. I started counting at like 1,000, but essentially I'm done with the Marine Corps. I mean, I'm doing an internship right now, which means I don't work for the Marine Corps. And as soon as the internship's done, which is mid-August, I will put the uniform on for 3 or 4 days to actually check out, and that's it. So it's just a little bit of admin from here. So for all intents and purposes, I'm done. I'm just not quite retired yet.
Yeah. Well, congratulations on that, man. I know it's been a long career for you, and we appreciate your service, but it got to be an exciting moment to get to that point of being able to step out of that career and now really just do whatever you want to do, right? Take control of your life and.
Yeah. Waking up every morning and, not having to, go to the Pentagon is just, it's nice. It really is. Or, there was a while where we were all teleworking too, but, waking up in the morning, knowing that you didn't have to go down and, log on to your computer at a certain time to make sure that everybody knows you're alive is nice, So, the first couple of days, it was just, easy, chill mornings, and it's like calm and just one less thing to worry about is all it is. Kind of like the Forrest Gump thing, it's just one less thing, one less thing to worry about, one less thing to do. So hopefully I'll be able to, capitalize on the extra time and, push some initiatives that we have running forward.
Yeah, man. Awesome. Well, Brian, for those who may not know you or your background, tell the listeners a little bit about, who you are and kind of how you found your way into Four Oaks, and we'll take it from there.
So I'll just talk a little bit about the military. 20 years, my official retirement date is October 31st. And it's no coincidence that it's 20 years after September 11th. The World Trade Center and the Pentagon attacks kind of lit a fire under me in a lot of ways. And that's when I decided to go active duty in the Marine Corps. So along the way, I had picked up a handful of single family properties, intentionally purchasing homes when I would move and turning them into rentals, when I moved again, So we've moved 10 times in 20 years, so that there's lots of opportunities to get an owner occupied loan on your house with that lower interest rate. Quite frankly, the first one I got was like a 6.5% interest rate. So not necessarily low, but, over the years, as rates have come down, it's just made it a little easier to do so. But about 3 years ago, I started seeing the light at the end of the tunnel. It was, and if you don't know, most people are probably aware, but the way the military retirement system works is, at 19 years, 364 days, you have absolutely no retirement. At 20 years and 1 second, all of a sudden, you're able to retire. So at the 17-year mark, I started seeing the light at the end of the tunnel. And I started realizing that if I didn't prepare, if I didn't have an exit plan, that I would just keep on, signing on for another couple of years. And, at the time, it didn't seem like a terrible idea, but I wanted options. So I really started researching what I could do. I had a handful of single family homes that I was renting out. Those gained a lot of equity. Some of them were cash flowing, some of them, but real estate had fascinated me. I always wanted to do more in real estate. And, so I started reading a lot more on the subject. I read books about, fix and flip, the BRRRR strategy, the subject twos, so many different strategies, and even, different commercial real estate books. But what I kept on coming back to was just the idea of apartments. It's something that everybody needs to live somewhere. And it's very similar to the residential experience I had, except on a different scale. And what really appealed to me was the fact that multifamily is very resilient over the long term, and we've seen that in this last COVID downturn. Multifamily has been extremely resilient, but the ability to scale quickly, it's you can buy 100 single family homes or 100 unit property, and if you compare the two, it's not 100 times more difficult to buy the 100 unit property. So when you start looking at how to scale and how to turn this into a business, to me it just made sense to go into multifamily.
Brian, you mentioned a really good point a second ago, and I want to highlight that the fact that you said have an exit plan. And I think, speaking to the military community in general, a lot of these military servicemen and women that enter into the long-term career, you're probably in your young 20s. You have a 20-year retirement plan, and so by the time that when you're getting ready to retire, you're in your, let's say, early mid 40s, right? So very, very young. And like you said, I mean, the big question mark is, well, what do you do after that? What are the options after that? So I think that's an important point to highlight, especially for any of our military men and women that are listening, is having that exit strategy. And obviously we lean towards real estate as being that strategy, but I think that it's a very important point to take away.
And there's, I can take that one step further. I could have gotten out at the 4-year mark. That was my first opportunity. And my exit plan was to go back to grad school, but I realized that exit plan was no longer feasible. I had a small family at the time, and going from, I was probably making $60,000, $80,000 a year. This was like 2005 timeframe. So I was making decent money for my age, mid 20s. And going back to a graduate school program with 2 little kids economically wasn't feasible. And that had been my exit plan. And because I didn't have an alternate exit plan, I stayed in. And I think if you look at the crucial junctures where I could have gotten out, my failure to plan kept me in the Marine Corps. It's obviously I enjoyed it enough where it wasn't a bad plan. It was, I've been promoted every opportunity to get promoted, and I've had some really good jobs. But end of the day, I think my failure to plan probably kept me in longer than maybe I should have, to be honest.
It's a big takeaway nugget. I think that can translate across any aspects of our lives, right? It's always thinking about the exit. Always think about the exit. That's important. So, well, cool, man. Well, I know you mentioned, you started picking up single family homes. You've discovered, the world of apartment investing. What was your first introduction into commercial real estate and your first apartment opportunity?
Yeah. The first introduction, I think, like a lot of people, books and podcasts. I just started devouring books and just listening to podcasts, and you got into what a lot of people were familiar with is just this, analysis paralysis, where it was just like, I need to know more. I need to know more. I need to know more. And then I started attending events. One of the major podcasters announced an event that was in the city that I was moving to, and I was just like, you know what? Should be pretty easy. I looked up the price and it wasn't terrible. So I think that was something that really changed my trajectory, is just going to an event, being around a lot of people who were doing what I wanted to do, and being able to to capitalize off of all that energy. And subsequently, I purchased got into a pay-to-play education program, which eventually led to a pay-to-pay coaching program. And those were invaluable to me. I mean, it cost a lot of money, but when I talked with my wife about it, I pitched the idea of spending $25,000 on a mentorship program, and she just, I mean, without a beat, just said, well, that's cheaper than the master's degree I'm looking at. So I was thankful she saw it that way. It was super easy to convince her. So we literally sold a single family home, and used that money to pay for the mentorship program. And we used that money to, put earnest money down on the first deal, and a lot of money into that first deal as well. So I ended up putting $100,000 of my own money into our first syndication. But it was really through this network and this community that I found my partners. And I think there's something to say about getting yourself around other people who have the same goals. So you get into a multifamily community and start learning more about it and rubbing shoulders with people who want to do it. Eventually, you're going to find somebody that you sync with and you can partner with, and that's exactly what happened to me. Met a guy named Eric, and he introduced me to two other guys, Brian and Todd, and probably 6 or 8 months after I first met Eric, we formed Four Oaks Capital. So got the first property under contract and started working together. It was probably 2 or 3 months after we had gotten the first property under contract that we formed the company and decided to be exclusive. But long story short, finding people through this community, being able to partner, has really helped me to reach my objectives. Working full time at the Pentagon, sometimes I don't have time to do the day-to-day stuff. Sometimes I didn't have time to poke my head out of the office and call the brokers back, or call the property manager or whatever. But being able to partner with other people and adding the value that I could when I could has really helped out.
Yeah, it's important. And I want to, well, first off, number one, your spouse wins like spouse of the year, right? I mean, there's not too often you hear the response of like, well, that's cheaper than a master's program. Most people have this negative stigma around these mentorship type programs. And I want to kind of talk about that just for a brief second, if you don't mind, is help us break down the stigma of some of these programs. Because I think, like you said, you're buying into a network, right? You're getting access to a community that is very like-minded and has resources for you to use. But I think historically there's been a lot of, and this is probably more many years ago than I think now, but there's just been a lot of people that have had negative experiences from these programs. And I don't think you need to have a program like this to be successful, but it definitely helps accelerate it. But break down some of those stigmas about getting involved in these type of communities.
Yeah, I think you hit the nail on the head. You don't need it, but it will help accelerate your success. I think there's two parts to the mentorship program, and here's where the stigma comes in. You have to find the right program, but you have to be the right person. So no mentorship program in the world is going to make you successful. You've got to be able to put in the time, put in the effort, and basically have the grit and tenacity to keep pushing forward. So I mean, a lot of the stigma is a lot of these mentorship programs are expensive. I've seen some from $25 all the way up to $60,000. I've seen a couple that are cheaper, but I think the question a lot of people have is, am I going to get my money's worth out of the program? And with the big price tag, I think there's a tendency with smaller price tags. I mean, how many times have you bought into, a $100 program or a $50 program and never done anything? I think the price tag helped me to actually commit myself 100%. I mean, it's really easy to shell out $50 for something. 25 grand is different. But, I mean, the stigma around it is really, is this program going to be worth the money that I'm putting in? Am I going to be $25,000 better, a year from now by investing this money or spending this money, depending on how you look at it. So End of the day, that's really what it is. And there are a lot of people, and I can't speak, specifically, but I've heard a lot of people who, point to these programs and say, snake oil, and it's a bunch of BS. It's just super simple stuff that anybody can do. It's not worth the money. But really, at the end of the day, I think most of those people are looking at it the wrong way. This business is simple. Okay, it's not easy. It is simple though. And so when you look at a lot of the content, you're scratching your head and you're like, man, that's super simple. I pick up the phone, I call brokers or ask for properties. Y'all, I didn't need a course to tell me that. But I think the other point you made, Cody, was you're buying into a network. There's a lot of people there who are doing the same thing you are, and there's a lot of people with experience who can, guide you through, the landmine field, because there's a lot of landmines out there too.
Yeah, I think there's something to be said, Brian. It's a great point about you get what you put in, right?
Yeah.
I think the huge misconception and where some people feel like maybe they're not getting value is, they go and they spend this 25, 30, $40,000 or whatever, and they're not an overnight success. They think real estate is a get rich quick scheme, and they fail to realize that forget the capital, there's a ton of sweat that goes into this, and no matter which hat you wear, whether you're in acquisitions or you're in capital raising or you're in marketing or you're in property management, like all these things require a tremendous amount of effort and time. And if you're not willing to put in that time, it doesn't matter how much the course is or who the instructor is or your mentor is, you're not going to get the results that you seek. And at the end of the day, you're going to end up with a disappointing result. And in reality, it's probably has to do with the amount of effort you put in.
Yeah, I think that's true of most programs. I mean, there probably are a couple of programs out there that are, really crappy, but I think the ones that have been around for several years have been around for several years because they're good and because, people have, found them, found success through the programs. But one of my favorite books, and I'm rereading it again, is, Jocko Willink and Leif Babin, Extreme Ownership, and it's one of those where you got to take responsibility for everything. It's kind of the point of the book. Take responsibility for everything. Don't play the blame game. I think a lot of the people that point the fingers at the programs, a lot of times are playing the blame game. They're not taking the responsibility, and that's why it didn't work for them.
Yeah, we've been talking about this a lot, right, Brian? I mean, we tell people all the time, you have to figure out who your investor identity is, because I think, like you just referenced, Brian, is that many people get into this space. They see the allure of all the success from the gurus, or they see people have 10,000 units and life is great. This is not a passive investment by any means, especially if you're looking to be active. I mean, actually go find the properties, put the deals together. I mean, it's a lot of work. Right. And so a lot of people come in and what they realize is like, hey, maybe they're better suited to be a limited partner or passive investor, or maybe this just isn't the right industry for them at all, just because of their expectation versus what you really have to put in here. So I think it's important for people to really understand your background, where you're coming from, and then what you're willing to put in to get those results.
Where you're at in your life too, right, Brian? You talk to some people too, and they really want to be active, but they've got 3 little kids and they're working 60 hours a week and they have a lot of capital. Well, they need to be an LP, right?
Yeah.
And maybe there's going to be a time and a place for them to be on the active side. But I think sort of looking at yourself in the mirror before you join one of these things and realizing, how much capital do I have? How much time am I willing to commit? Is my spouse on board? We kind of alluded to that earlier, because there's going to be a lot of late nights and a lot of weekends and a lot of calls, at weird times of the day, sort of interrupting your normal workflow. And if you don't have all those boxes checked before you jump into one of these things, you're going to probably hit quite a few roadblocks.
Yeah, there was a guy that I talked to, fairly recently. He was talking, the first conversation we had was about him becoming active, active in the, active investor, searching for properties, being a deal sponsor. And, when we talked, I was just telling him everything it took, and it took a lot of nights. It took a lot of weekends. It took, every day of vacation in the last 3 years that I've taken has been spent, viewing properties or whatnot. But, a week later, he called me up and he's like, you know what? Instead of that money, that I have set aside going into an education program, I decided that I'm going to be an LP. I'm going to be an LP for a while because I don't have the time. Time commitment is huge, and I don't have it. So, he's looking. We've got a deal that we're running right now, and fortunately for us, he's going to be investing with us. But yeah, I think that's a good point. Look at your resources, what you have. If you have a lot of time and no money, it's pretty easy. You want to become active. If you have a lot of money and no time, pretty easy. You be a passive investor. You got a lot of both. The world's your oyster. So.
Yeah, you're absolutely right. I mean, that's the cool thing about, I think, real estate investing in general, is that there's so many different avenues to find your way in, right? You don't have to always be the one doing all of the hats, right? You can, and especially in the commercial real estate space where it's such a big team sport, there's so many different roles, responsibilities, as you mentioned, Brian, and you can find your way in without having to take on all that responsibility. So, but going back to the educational platforms of today's time, I think that there's one big benefit of technology now is that we have so much information that's readily accessible, that's free, good content. Things like what we're doing now, right? A podcast or other thought leadership platforms that people can easily participate in for free. It's forced a lot of these mentorship programs to provide that better service or that better value add, right? It's not just, hey, I'm taking your money and good luck. It's hey, here's really good concrete ecosystem and resources and network and things like that you can really benefit from, because otherwise the alternative is you can get a lot of this information for free.
Yeah. And I started trying to do that. I honestly did, and I had on my phone running, on Google Notes, I think is what I started using. But every time I'd listen to a podcast, I'd log it in, and it would be like, okay, Rod Cleve episode number 321, and I'd take notes about, what the lessons learned were, and it was one of those things where I figured, all right, I don't need this now. They talked a lot about due diligence. I don't have anything under contract, but when I do have something under contract, I can come back to this episode and listen to it. And, it was the problem with that, with a lot of the free content, is there's a lot of big gaping holes, is what I found. And I mean, you can find a lot of information on podcasts. You can find a lot of information. There are some very good books on the subject that are a little more complete. But end of the day, I think one of the biggest catalysts for me was being around people who were doing it. I mean, information is one thing, but you got to eventually take action. And, in my scenario, it wasn't until I got around people who were taking action and who were doing it that I realized that I can do it too. And that's what got me off my, analysis paralysis perch and, turned me into a man of action.
Yeah, I think that's really important. And that analysis paralysis part keeps coming up, but I think a lot of people, sometimes they get into these programs, and I know I've personally been asked this question, and I don't know about you, Cody, and maybe you too, Brian, but people ask me, like, when was your training done? Like, you get into these programs and they're like, oh, when did you finish your training and start investing? And they're sort of looking at it in the type of mentality that's more of like a job, right? Like, I get trained and then I go do my job, when in the reality, the best training you're going to get is actually on the job. It's going to be doing, actually taking action, working with partners that are experienced, sort of getting your hands dirty, getting those bumps and bruises that kind of come along the way with learning.
Yeah.
But the educational piece is absolutely important, but there's something to be said that's even more valuable about taking the action, because some people, you run into people sometimes, they're like, oh yeah, I've been in multifamily for 18 months and, I haven't bought anything. I haven't passively invested in anything. I'm just in the education phase. And I'm like, well, how long are you going to be in the education phase?
Is a long time.
Yeah, that's right. So,
yeah, I mean, the opposite question I get a lot, I haven't really decided how to answer when people ask me, how long have you been in this space? I mean, where do you start the timer? The first time you read a book on multifamily, the first podcast you listened to, the first offer you put in, the first property you walk? I don't know, the first contract you get, but that's another thing too, where there's no clear start time and there's no clear, hey, you've arrived. It's a continual process. You're trying to get better. You're trying to take, lessons learned from your mistakes and from watching other people. And that's huge. I mean, talking to other people about, how things are going. you get to learn little nuggets here and there about things that could potentially happen, and how to address them once they do. But yeah, there's a lot of people who know a lot about this industry. There's a couple people that I've seen at events, for years and years and years, and it's just like 3 years later, they're still in the same spot. I just haven't found the right property yet, but we're continuing to. Hey, at some point, you got to take the plunge. You really just got to, jump in head first, and that's the best way to learn. That's the best way to grow.
Yeah, the education never ever stops, and it doesn't matter what level of success you reach in your business, right? I mean, and because there's always going to be some new dynamic, always something new to learn. Every property is going to be different. Every market cycle is going to be different. I mean, look how many. Nobody has ever experienced a global pandemic over the past year. No, none of your experienced operators have ever experienced something like that. So everybody was learning through this and how to navigate those waters, right? So the point being is, I think, like we've been saying along, is eventually you got to just take a step of faith, and are you going to get knocked down? Sure, but that's you learn.
And a year ago, when everything shut down, or actually been a little longer than a year, I think most operators, took a pause around March of last year. Most operators are just like, do we really want to do this? But we closed on a property in June, and we had another property under contract, when we closed on that one. So when you look at that, there's a lot of things that happen, but there's still good deals to be had in every market. And the deal we closed on in June has just performed phenomenally. And the deal that we had under contract and closed on in September has performed phenomenally, and so it's constantly learning, it's constantly looking at things, and we always ask ourselves, what can go wrong? What risks are there out there, and how can we mitigate the risks? So with these two properties, with the pandemic, 3 months, still a brand new thing, we underwrote both properties to 25% economic vacancy year one, and we've probably had 10 to 12. So one of the properties we forecasted 0 cash distributions year one, and we've already kicked out 50 grand. At 6 month mark, we kicked out 50 grand. And the next quarter is coming up soon, and we should have more to push out. But at the end of the day, you always have to be learning. You always have to keep your finger on the pulse of the marketplace. And if something like COVID comes up, or whatever the next thing is, just try to ask yourselves the question: what could potentially go wrong with this? How do we mitigate it? And how can we continue to move forward and still bring good deals to our investors? So anyway, it's a continual process of learning and adjusting.
Yeah.
What's the saying, Cody? The best time to invest in real estate was yesterday, right?
That's right.
A lot of people, they get analysis paralysis, or they're looking at these deals and maybe they're uncomfortable with their risk mitigation process because they're not experienced. But you miss out. Those deals that you bought, I'm sure, would trade for a phenomenally marginal amount more, in those markets. Like just here in Houston, I know 6 months ago, Cody, give or take, C-class asset, we're talking high 70s, low 80s K a door. I don't think we've seen anything under 130 grand a door here in Houston. And now it's 2021. So the people that were scared of buying, that were uncomfortable with risk mitigation during late last year, and that are still scared of buying, they're going to look back in 6 months, a year, 18 months, whatever the time being, and go, man, I should have bought back in 2020. I should have bought back in 2019. When in reality is like you said, you have to sort of have a leap of faith, of course, but as long as you have the right team in place, right? You have your mentors, you have your coaches, you have somebody on your team that's experienced, that's been through enough to be able to give you that guidance. You have to take that leap of faith, take action, and get that first deal done.
Yeah, and the one we closed in June, that'll probably be the first one we come full cycle on. We paid $2.4 million for it. I think we had an $800,000 CapEx budget, so we were all in at 3.2, 3.3 ish. We've had a couple of unsolicited offers in the last month, all above 4 million. So One of them was at 4.4, so $2 million more than we paid for it, a year ago. Now, granted, we put $800,000 in repairs into it, but so if we do end up selling it, that's a really nice return on your investment. And if we get what we think we can get out of it, I'm not going to put numbers out there, but the returns are going to be off the chart. It's going to be one of those things where people are just going to, we're probably going to hit our 4-year projections around the 18-month mark.
Brian, I'm going to use this to kind of segue into a topic that will tie into this, because you and I had the pleasure of participating in a panel a couple of weeks ago with our mutual friend, Mr. Bronson Hill. And we talked about, what a good multifamily deal looks like, right? And a lot of what we talked about is vetting the sponsor and looking at, the deal and make sure it fits your investing thesis. And the reason why I bring this up is I think, given the level of aggression that's in the marketplace right now, you have a lot of guys in a very similar position, a lot of operators who have purchased assets, let's say leading up into COVID, maybe during COVID, that have now appreciated so much in value just because of the demand and the appetite, that you have a lot of guys who may not be the best in class operators, but look like geniuses on paper because they just 2x their multiples in 18 months, 2 years, some even less than that. And so I think it's very, very important that, anybody that's listening to this, tying back into the importance of education, is really understanding how these deals should be operated and how these business plans should be executed, and how important the sponsor is. Because my fear is for the space is that a lot of these guys are going to come out of this looking, high and mighty, when in reality, if things were on a level playing field, the opportunity would have been completely different. Does that make sense?
Yeah, completely makes sense. And I mean, people have been the benefits, and it's not just the last 2 years, maybe the last 10 years, they've been the benefits of just real estate prices, going up. Cap rates have been compressing, and so, 5 or 6 years ago, it was common to get apartments at an 8 cap, and now in secondary markets, things are trading at low 5s, which just means the price has gone up significantly. And part of it in your underwriting, I expect cap rates to continue to compress. I don't know how far they're going to go, but looking at my tea leaves and trying my best to read up on it, economic factors and things like that, I think cap rates are going to continue to compress, and a lot of operators are going to benefit from that cap rate compression. But when we underwrite deals, we don't underwrite them with cap rate compression. So the one that we're looking at, one that we have under contract right now, our reversion cap rate is a 6.2. So we're assuming that 3 years from now, we're buying at a low 5. We're assuming that 3 years from now, cap rates are going up and not down, and we're still projecting mid to high teens on the returns. So I mean, end of the day, it's just the conservative underwriting. It's hard to do in this market and still get find things under contract, but you still have to hedge your bets. I think cap rates are going to compress. I think this is going to be a phenomenal deal. I think we're going to crush our projections, but at the same time, what if the market turns the other direction? What if something bad happens? So and what it's really done for us is the last 2.5 years, we've always had a project under contract. Before we close on a property, we've got the next one under contract already. And we had basically a 6-month drought where we weren't finding anything that met our standards, and we finally did, and should close on that one soon. And then hopefully we'll have the next one under contract soon too. But anyway, yeah.
Yeah, a lot to unpack there, because I think you brought up a lot of great points there, and it's kind of funny you mentioned your tea leaves there, because I was going to ask you to whip out your crystal ball and kind of get your forecast on the marketplace. And I think Brian and I would agree with you. I mean, I think this the what we're seeing in this space right now, I think, is going to continue for a lot longer than a lot of people expect. I think that we're going to continue to see the cap rate compression. I think, we're going to continue to remain in this very low interest rate environment. And you have this perfect storm, right? You have this looming or inflation that's here now, but some people project that, okay, this could run for some time, and then you have low interest rate environments, cap rate compression. It's just perfect storm of just highly appreciating valuations in commercial real estate or real estate in general.
And then we've got all these articles coming out, I think this week or the last couple of weeks, right, about all these REITs and insurance companies that are selling their office, selling some of their what they consider riskier assets, and moving capital over to multifamily, right, which makes it challenging for operators like us. So I agree with you two gentlemen that we're going to continue to see a very competitive market space and a lot of appreciation in our asset class.
Yeah, but going back, go ahead, Brian. Go ahead.
I was going to say, I read an article this morning about what the Biden administration economic plan is. And I mean, they are banking on this, what's happening now, what a lot of people are calling inflation. They're banking on a supply and demand imbalance. They're calling the current big raise in prices a supply and demand issue. People have been, shut up for a year, in their houses, and the people who've still had incomes haven't been going to the movies, haven't been going out to eat, so they saved a lot of money. And now that things are opening back up, you've got a lot of pent up demand, and you got a lot of people with extra money in their pockets. So in a lot of ways, that's fueling the high prices because the supply chain hasn't caught back up. And so when you look at what the Biden administration is doing, is they're looking at the current rise in prices as a blip, and they want to look 4 to 8 years from now, which I think is the right way to do things. They're looking at the long-term health of the economy. And that means they're keeping interest rates low, and they're going to keep the interest rates low for a while, until the supply catches back up to the demand train. And that's I think that bodes well for commercial real estate. We'll still have low rates. All that extra money, Cody, as you mentioned, is getting pumped into the real estate market, which is pushing prices up. But I don't think there's a bubble. I don't think we're going to be coming back down anytime soon.
Well, the reality, Brian, is just that there's not enough homes for people, right? We've had this issue for decades in the US where there's not enough single family houses. They can't build them fast enough. And that's going to, benefit us as operators long term. And same thing with multifamily. I mean, just in our neighborhood here in the suburbs of Houston, there's, A-class products popping up all over the place, and they can't build them fast enough. So until we get some sort of close balance, or that it catches up, like you mentioned, I think that's just another contributing factor. So there's just not enough homes for people.
Yeah. So, I mean, supply and demand in this case is in our favor in the apartment world. Everybody has to live somewhere. And that's the difference between retail and office and industrial, is you can always find different places. People can work from home. We found that out. People can sell from home. eBay and Amazon have proved that. People can, store stuff in other places. So it's there's lots of, or we can import stuff from overseas, but there's always that demand factor that multifamily is going to have that the other commercial real estate asset classes, may not long term.
The secret is out.
Well, Brian, let me ask you. So, you have your own forecast for where we're going to go in the marketplace, right? And you obviously have education. You're always keeping your finger on the pulse. You're kind of keeping attuned to what's happening and what's influencing us as business owners in the real estate space. Has your strategy changed now with this forecast versus where you were, let's say 2, 3, 4 years ago?
Our strategy has always been value add, workforce housing. And I don't think our strategy is going to change anytime soon, because with value add, you control a lot of your returns. You find some place that's undervalued. You find some place that has, below market rents. You find some place that's, needs some TLC, so to speak. And, if you buy right, you can control a large percentage of the returns, and you don't need, the wind in your sails to push your investment forward. So I think the fundamentals are still there. If For example, the one we have under contract right now is in a metro of about 250,000, and it literally has the lowest rents in the city it's in. The lowest rents in the entire city. So when you look at a deal like that, we're going to put $1 million, $1.5 million in capex in, and that's going to make it a nicer place. That's going to allow us to bring it up to, we're not even trying to bring it up to the median rent price for C class. But so when you look at that strategy, we control a lot of the appreciation. We can force the appreciation, as a lot of people say, and we can control a lot of the projections that we have on paper, and we don't need cap rates to compress to make money. And so I think that's a good strategy in most markets. But if the market turns south, we're still good. If the market keeps on chugging like it is, we're going to have phenomenal returns.
Yeah. To kind of continue down that path, in speaking to that, I feel like those opportunities are getting harder and harder to come by, right? Where you find those really true value add opportunities. Where do you see more of the value add opportunities moving forward in the space, over the next few years? Because it's getting increasingly harder to buy, right? To your point.
Yeah, I would say secondary and tertiary markets are where it's at. When you're in the Charlottes and the Atlantas and the Houstons, in the urban core areas, those things get bid up quick and they get snatched up quick, and a C-class value add property goes, on sale somewhere in Houston, it's probably going to have 10 or 15 offers, so it's hard to buy
more.
Or more. Yeah. Or more. I've heard excess of 20 on some of these places, but in the secondary and tertiary markets, I think a lot of people are starting to move out there, and that's why cap rates in the secondary and tertiary markets are also rising, because number one, people are moving to secondary and tertiary markets, and investors are moving there, so that there's not quite as much demand. Like I said, we got a property under contract in a metro that's 250,000. That's a tertiary market, but the economic drivers are there. So I think you got to look a little bit more off the beaten path. I think you got to look for those diamonds in the rough, so to speak, and look for things that other people may not see, and try to take advantage of that.
Yeah, it's a great point. And it's funny you mentioned that Houston and whatnot. Brian and I know all too well. We've been in best and final on several deals as of late, and the best and final rounds are 10, 12 offers. Yeah. It's insane that the amount of competition that's out there. You're right. So, but I think it goes back to your point when you go into the secondary, tertiary markets. You mentioned this earlier, right? Their fundamentals are still in place. Make sure you check your fundamentals. Make sure you vet your markets and understand that demographic very well, and make a good sound decision. So, well, Brian, I want to kind of circle back, kind of going back to the discussion about education, because I know you're about to release an education platform.
Yeah.
And you provide such great content through your thought leadership platforms. Tell us a little bit more about what you guys are getting prepared to launch.
We want to launch a community. I think we talked about this earlier. There's a lot of people who put education out there. We want to make it a community that's built around, multifamily education. So for the last year and 3 months, I have run, a weekly meetup. I've done, monthly networking events and webinars, and, a whole year worth of podcasting now. Wow, it's been a year. But just taking everything and putting it on a platform. We're going to call it Tribe of Titans. Right now we've got about 20 people in as beta testers, and so far the reviews are extremely positive. But the idea is to bring people together, and give them everything they need to succeed. It's not just education, it's the mentorship, and it's the potential partners. It's being able to see other people who are doing what you want to do, and we're going to bring that to pass. And that's my full-time job for the next, until it's up and running by itself. That's going to be my full-time job. So Anyway, it's Tribe of Titans, and you can find more information on it at www.thetribeoftitans.info. So anyway, we will launch first week of July, right after the 4th of July holiday.
I like the title, Tribe of Titans. It's like, I don't know, it gets me like, I'm ready to go.
Pumped up. Let's go.
Amped up. That's right.
Yeah, we're gonna have some Titans in there too. So it's gonna be a good venue for people to show up and learn. And it is gonna be pay to play, but we're gonna price it pretty cheap up front, trying to get as many people through the door as possible. And we'll grandfather people in. So just it's gonna be a monthly subscription fee, and it's gonna be less than a cup of coffee twice a week is about what it's going to be.
Yeah, especially the way the cost of coffee is going up, right, Brian? He knows that all too.
Let's not go there, Cody.
Maybe a coffee at McDonald's twice a week is not the Starbucks or the premium stuff.
Yeah.
So.
Well, I'm really excited about this, Brian. Again, for those of the listeners who may not know you very well or may not tuned into your thought leadership platforms, you offer such great value add content to the investing community, through your podcast, a phenomenal podcast, your meetups and such like that. So I definitely would encourage anybody who hasn't already to get tuned in to your thought leadership platforms. Check out this Tribe of Titans. I think it's going to be a phenomenal education community. And this is what it's about, right? It's about, like you said, surrounding yourself with like-minded people in the space. And we talk about this all the time, right? I love the multifamily space because it's such an abundance mindset across the space. When you can sit people in a room together that all have the same vision, same goals, there's a lot of success that can happen when you get yourself surrounded by those people. So really appreciate that, Brian. Really look forward to that.
All right. Hey, thanks a lot, Cody. Thanks, Brian. And I appreciate you guys inviting me on your podcast today. This has been a lot of fun. Yeah,
man, it has. I can't believe it's taken us a year to get to this point, but better late than never, I always like to say.
Yeah,
so
it's funny. I don't remember what happened, but we agreed a year ago to do a podcast swap, and we probably were both really busy at the time, and it just never came to fruition. But here we are a year later, and I think both episodes will be a lot better because of it.
I think so, man. I think so. And I appreciate the relationship that we have been able to build over the past year through our various mediums. And, definitely looking forward to coming on your show and just continue to share stories and experiences. I think it's going to help out the community quite a bit. But hey, don't go just yet. We got three more questions for you before we wrap up. Okay.
All right.
All right, Brian. So tell the listeners what you like to do for your continued education to further your own investing.
I do a lot of reading, and it's articles, it's books, it's LinkedIn, it's newspapers. I mean, not the physical newspapers. I just try to read as much as possible, and then spend time digesting, what I've learned or what I've read, and I tend to do my own analysis. I don't believe what commentators say half the time. I try to make an independent analysis on what's going on.
Yeah. Awesome. What have been some of the lasting lessons you've learned along your journey?
The hard work and consistency, I think are important, but, you have to add the right direction. Hard work and consistency, pointed in the right direction it's a secret to success in anything, so three things right there. Make sure you're pointed in the right direction, make sure you're moving forward, and make sure you keep moving forward. And boom, you're gonna be successful in whatever you set out to do.
Awesome, man. Awesome. Any advice that you'd give to listeners to help them further their own investing?
Take action. I mean, there's a point in time where you know enough. Okay, you probably know enough right now to take the next step, whatever that next step is. So don't be afraid of the next step. Just take it.
Excellent advice, man. Yeah, great advice. So. All right, Ron, tell listeners how they can learn more about you and get connected with you.
Well, we already talked about the Tribe of Titans website. Four Oaks Capital also has a website, fouroakscapital.com. I'm on LinkedIn a lot, and podcast is Diary of an Apartment Investor. If you want to listen to me talk more, I don't know who would. I have a hard no, just teasing. But And then email Brian Briscoe at fouroakscapital.com if you want to just reach out to me.
Awesome. Awesome. Well, Brian, thank you again so much for tuning in with us today, man. Really respect you and everything you're doing for the community. Keep crushing it, buddy.
Thanks for joining us, Brian.
Thanks, guys.